We are back on a track to normal monetary policy. The Bank of Japan governor summed up the policy meeting set today. Thus, the world's last source of cheap money does not longer exist. Japan's regulator became the last central bank to abandon negative rates. That's March 19, 2024. Is the official end date of the era when policymakers around the world sought to prop up economic growth with the help of cheap money and unconventional monetary instruments. Today, the key interest rate in Japan has been raised to 2.1%. In other words, it has been transferred to the positive zone. It was the first hawkish decision since 2007, and the regulator had to tighten monetary policy on the back of stubborn inflation, which has been stuck above 2% for more than a year. Another reason behind this move is the largest increase in wages in the Japanese labor market over the past 30 years. Meanwhile, market participants are trying to puzzle out what will happen to Japan next. First, the inflow of the money that Japanese investors have amassed in foreign companies back home could well shake up global financial markets. Besides, Japan's own monetary policy risks being stuck at zero. That's Japan will no longer be able to significantly raise short-term interest rates in the coming quarters due to the fragile economic recovery. In addition, Japan's national debt is more than twice the size of its GDP. Thus, according to estimates of 2022, the ratio of these indicators was 263.9% in 2023. Judging by the preliminary data, the ratio will be even higher. As for the yen's position, the Bank of Japan's landmark reversal in rhetoric had already been largely taken into account over the previous few weeks. Amid signals from the central bank and media reports, monetary tightening was imminent. That's why today the US dollar index, whose basket of currencies also includes the yen, has not suffered at all from the aggressive auctions of the Bank of Japan, and the US dollar index maintained its bullish momentum in the range of 103.50 to 104.10, even despite positive data for the eurozone. The index of economic sentiment in Germany published today locked growth for the 8th month in a row. It rose to 31.7 points in March, exceeding forecasts and reaching its highest level since February 2022. Economic expectations for Europe's most powerful and world's third largest economy have improved significantly as investors anticipate rate cuts by the ECB over the next 6 months. The list of ECB policymakers who are ready to discuss a rate cut as early as June is already quite long. Among the 26 eurozone central bank governors, regulators from Spain and Netherlands, Ireland, Greece and Slovakia publicly backed the first rate cut in June. And today they were joined by ECB Vice President Luis de Guindos. However, investors are skeptical about such bold plans and believe that the European regulator will not dare to act at its own without the support of the Federal Reserve. Analysts expect that the main catalyst for forex now is expectations for monetary easing and the number of rate cuts by the Federal Reserve this year. As for policy meeting in March, the Fed is widely expected to maintain the status quo. Of course, investors will focus on updated economic forecasts as well as the comments from Chairman Jerome Powell. And now forecast for the timing of the Federal Reserve's transition reaction to a softer policy suggests a fairly wide time frame from May to the third or even fourth quarter of 2024. However, Wall Street tries to ignore hawkish scenarios for the Fed's actions. On a Monday, the S&P 500 even broke its three-day losing streak and tested the area above 5,170. However, Tuesday was less successful and sent the S&P 500 back into the bearish corridor between 5,145 and 5,175 points. Meanwhile, the US dollar continues to strengthen its position, and today its rise in the index looks very impressive. The main driver of the greenback's advance against all its peers in the currency basket was the prospects for a more hawkish actions by the Federal Reserve revised by the markets. The position of the euro was no exception to this rule. Today, the euro is trading lower today in the intraday corridor between 1.0838 and 1.0880 against the US dollar. Moreover, the greenback is likely to strengthen even more before tomorrow's announcement of the policy decisions by the Federal Reserve. For now, we are watching the ongoing correction of the euro-dollar pair due to bearish inertia. Today, the instrument is already slightly lower than yesterday's values. The growth of the US dollar may force the single currency to test the psychological support level of 1.08. Importantly, inertia itself is very unstable. Speculators can abruptly move to profit-taking on sell positions. In this case, the euro risks going through a technical pullback. The advance of the US dollar moderated growth over oil prices, and Brent Crude, for example, was able to break through the level of $87 per barrel, but attempts of a further rally now look vaguer. On the contrary, on the back of market expectations for the Federal Reserve's policy decision, a correction in oil prices seems inevitable. There are no fundamental reasons for the growth of oil prices. Nevertheless, there was a massive 1.8% price jump in recent days. Our analysts admit that a local correction in oil prices could begin today. In this situation, market participants are still neglecting signs that crude oil is overbought because the market is driven by speculative sentiment. However, sooner or later, traders will rush to take profit, and the Brent price will begin a technical pullback. You have watched the market review by InstaForex analysts for Tuesday, March 19. Subscribe to InstaForex TV channel, and we keep you updated on all market developments. Feel free to ask any questions and leave comments. See you online tomorrow.